been basically in a bull market since the 2008 crisis, the reversal of 2009. The markets are due for a massive sell-off. The economy is due for a beatdown. And the overall, you cannot keep giving free money away and building massive amounts of debt as a country and expect that not to at some point catch up with you. I mean, it's a shell game. It's a Ponzi scheme.
Back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a very exciting discussion lined up today that I'm very eager for. Today, we're fortunate to have with us Todd Bubba Horwitz, founder of BubbaTrading.com. Todd, welcome back to Metals and Miners, and thank you so much for joining us today.
Always great to be with you, Gary. I'm looking forward to it.
All right, great. Todd, Deutsche Bank says that we're not just facing a usual dollar crisis, but the start of a bigger rejection of U.S. assets caused by unpredictable trade and currency policies, declining global trust, and countries moving away from the dollar. Do you think completely changing U.S. trade and currency policies is the only way to rebuild market confidence, or could the Federal Reserve, Treasury, or even global players take other steps to basically stabilize things before we have a major financial crisis?
Well, I mean, first of all, I call BS on Deutsche Bank, and I think that we've gone through these markets before. You want to talk about the dollar first? The fiat currency system is the most manipulated garbage that you've ever had. I mean, there's no backing against anything. All we have is governments backing currencies, which are controlled by their central banks. So this reduction in the dollar, this sell-off in the dollar, is really more to overcome the price of the tariffs that we have coming in. So I don't look at it that way. I think there is a major meltdown coming, but I think it has nothing to do with the trade policies that we're watching now. I believe that the banks in this world, and in this country especially, are so far over-leveraged, A, because they always are over-leveraged, but B, because President Biden let them during COVID go well past the 10-to-1 debt to ratio. And of course, at some point, these debts reset, these loans reset, and there's going to be a problem. So I don't put this on the trade. This magically didn't appear today because of what's going on. This has been building for quite a while. I mean, we've been in a recession for over a year. If you make under $250,000, you've been in a recession. So again, I don't put this on the trade.
Okay, so speaking of tariffs, we've clearly seen evidence recently that consumers and businesses remain financially healthy, yet much of the current strength appears tied to front-loaded spending ahead of the tariffs. How sustainable is this economic momentum once the effects of higher prices kick in more broadly? And could the delayed pain from the tariff pass-through end up accelerating, recession risks even higher up that food chain that you were just talking about in the second half of the year?
I think they could, but I'm a big fan of the tariffs. I'm a big fan of what President Trump is doing. I believe that it's finally time to put everybody else back in their place and show who the true leaders of the world are and who the most powerful is. And I think that when you look at the picture, again, problems like we're looking at now and like you're talking about just don't suddenly appear because we have a new president or because he's got some different policies. These things have been developing over years and years and years. And of course, we've been basically in a bull market since the 2008 crisis, the reversal of 2009. The markets are due for a massive sell-off. The economy is due for a beatdown. And the overall, you cannot keep giving free money away and building massive amounts of debt as a country and expect that not to at some point catch up with you. I mean, it's a shell game. It's a Ponzi scheme. Create money to satisfy the old debt. So again, they're going to blame this on the tariffs or whatever. They're going to blame this on President Trump. But at the end of the day, this was long in coming. And I think we're just scratching the overall surface right now.
All right. So speaking of the pain that you're talking about, Todd, the Fed just slashed its Treasury roll-off to $5 billion from $25 billion, which was down even further per month. Essentially a rounding error given the size of the balance sheet, right? Despite Jerome Powell's insistence that it means nothing. Is this the opening move in a stealth return to QE? And what signal does this send about the health of the long end of the Treasury market?
Well, we could be going into another QE. I think that obviously will depend on when the banks finally determine and we finally figure out that the banks are not as strong as they are, as we think they are. This will come when the stress tests, the phony stress tests that they run, okay, telling us how good they are. I mean, look, the overall Federal Reserve is a cartel. They have no interest in Americans. They have interest in taking care of the banks and letting them make money. That's how they became too big to fail. So when we look at the big picture here, they're making adjustments to potentially, go back to the zero rate policy. All the things they did that were ignorant and stupid in the first place, they're looking to replace those errors because let's face it, the Fed is a cartel. They have no interest in ordinary income and ordinary people. They have interest in themselves and taking control. I mean, look at who controls the Federal Reserve. Look who started the Federal Reserve. So again, this is not, the Fed is a bad organization that has no interest in anything but taking care of the banks. And of course, we've just witnessed the Fed cut rates. They cut 100 basis points since last September. In the meantime, since last September, the 10-year notes have gone up 150 basis points. So where are we when you really look at the bigger picture?
Well, that's an interesting point that you bring up about the 10-year. So Treasury Secretary Scott Bessent about a month or two ago basically came out and said, hey, we're not worried about the rates. We're more focused on the 10-year. And then since then, the 10-year, it plummeted and then it jumped back up. Do you think, they're actually trying to impact the 10-year, or do you think they're trying to put the spotlight on the 10-year in order to force the Fed into action at some point when the 10-year gets too high?
Well, I think they may be trying to force the Fed. I mean, obviously, President Trump, who is wrong, wants the Fed to cut rates because, of course, that gives you the illusion, the appearance that everything is okay. But at the end of the day, the 10-year should be probably somewhere 6% or north up. If you were born, if you're my age, okay, you realize that interest rates are awfully cheap, even at where they are now. Even at 7% mortgages, they're still pretty damn cheap, considering that my first mortgage was 14%. So again, I think that we don't take into consideration what the free market really wants. And the free market says that there's a demand for money and they can get a higher interest rate. And we don't need the involvement of the Federal Reserve. The Federal Reserve is a hindrance to the economy, not a help for the economy, because they're so far off mandate. Mandate for the Fed is jobs and stability. Okay. They're manipulating rates, trying to make things happen, which is totally false. So Bessent, who I think is going to be a great Treasury Secretary, he's talking nonsense, but I think he's talking to the president, and the president wants rate cuts because he doesn't want to go down as the president caused another recession. In the meantime, if they cut rates, you're going to have that recession faster than you think, because inflation is going to go through the roof, and it's already high. We are getting some breaks now through some of the products, but overall, inflation and recession are not a good mix.
All great points. The question I would put out there to you would be, if rates stabilized around the market rate of 6.5%, 7%, with 37 trillion in debt and growing, how do they service that debt, especially with that huge debt wall that's coming over the next 2 years? How do we service that with the budget that we have when we're already, 2 trillion in debt?
Well, maybe you fix the budget. Maybe you quit spending money that you don't have. Maybe you quit running the Ponzi scheme that you're running.
But I mean, wouldn't they have to, in that case, adjust Social Security, Medicare, Medicaid, because those are the real big pillars that are causing.
Again, that's the problem. This is one of my biggest complaints. Social Security is not an entitlement. Social Security is something that each and every individual puts their own money into.
Exactly.
And if they put that money into their own IRA, starting when they started Social Security at whatever age you started working, you'd have a hell of a lot more money, and the government wouldn't have used it to put you in massive debt. So
exactly.
Social Security is not an entitlement. Social Security is something that I personally paid for my entire life, my entire working career. I put money into Social Security so that the government could borrow that money and create that Ponzi scheme. The first thing they need to do for that part is to make retirement age 80, not 65. The whole system, our whole system is so backwards right now.
Yeah.
And again, it's not just today, but it's been backwards because the politicians want to keep stealing money They want to keep getting elected. So if you really change the retirement age, you can't change it for somebody like me who's already on Social Security. But but anybody who's coming into the workforce today, you could say your retirement age is going to be 80 because the whole system was based on people dying before they ever collected.
Right. Okay, so there's a lot of trails we can go down on that. We'll stay away from that for right now. Using Goldman Sachs historical data, Todd, structural bear markets in the U.S. since the 1980s, they've averaged about 50% decline compared to 30% for cyclical, 25% for event-driven bear markets. Do you believe we're in a structural bear market right now? And if so, is it your expectation that we're going to see at least a 50% decline here?
Yes. I've been wrong for the last year or so. I have said that we're going to see a 40 to 60% haircut. So let's say we'll call it 50. All right. I think that is definitely coming. I think that, again, this is where somebody's got to have the stones to step up and say, hey, this whole economy is built on, if business goes out, there'll be somebody in to come and replace them. You cannot continue to try to soften any blow. Let it happen and let it go. And that is, of course, the problem with the Keynesian economic theory versus others. Again, I'm not saying that Austrian or any of the others are better or worse. I think that there's a better mix and a better combination. But trying to borrow your way out of debt or produce money out of debt does never work and will never, ever work. And this is one of the bigger problems.
Yeah. So there's a lot of pain ahead in a 40 to 60% drop. A lot of people are not going to want to take that pain. And, a lot of the administration and whatnot, they're going to do something right to try to prevent it. Okay. Yeah.
Listen, they couldn't prevent it in 08. They couldn't prevent it in 87. They couldn't prevent it in 01. And eventually it always catches up to you.
Yeah.
Okay?
Math is math for sure.
So I'm sorry. I didn't mean to interrupt.
No, you're fine. I'm glad you did. But what happens to tax revenues if we do experience we saw in 2022 when we saw a 25% haircut in the market, we saw some significant tax revenue declines. We're already 2 to 3 trillion in debt on an annual basis. What happens, in that scenario to tax revenues?
Well, again, tax revenues, if they go down, they go down. We're way past what tax revenues are. The first thing is you have to fix the budget. You have to fix the spending. Okay. We spend too much money. You give too much money away to other places, which is part of the trade program and which is part of the tariffs. Again, how much money have we given to Ukraine? How much money have we given to other countries? It's about time that we give the money back to this country where it belongs. So yeah, tax revenues will come down a little bit, but it doesn't, just because the haircut of the market is happening doesn't mean people aren't working and paying taxes.
Of course.
Most people aren't paying taxes on their 401k and their IRAs, okay, until after they take the money out. That's where the tax revenue is concerned. So if there's jobs and there's people working, they're going to have tax revenue. Yeah, maybe it'll come down a little bit or not. But again, there are so many other ways to fix those issues when some of our politicians would finally wake up and say, well, maybe we should fix the budget. Maybe we should quit spending so much money everywhere else. How else did you get $39 trillion in debt? And that doesn't count that the $10 trillion shortfall that Social Security is going to have in 10 years from now.
Or the off-balance sheet liabilities. It's over 100 trillion, I think. Okay. Yeah. All right. So Todd, Bank of America's latest fund manager survey reveals near record bearishness on macro conditions, with long gold now rated as the most crowded trade and a trade war that's triggering a global recession. That's the top tail risk. So given these sentiment extremes and structural repositioning into defensives and bonds that we're seeing lately, do you see this as a contrarian signal that we may be approaching a turning point in the markets, or is this just the early innings of a deeper risk-off environment that's going to accelerate without a major policy shift from either the Fed or the White House?
Well, I'm never a big fan of any of the big banks when they make ridiculous statements, such as Bank of America saying that we're in the most bearish sentiment. Are we? I don't know. I mean, again, if we were, there would be some more signals. There'd be more selling right now. I mean, we haven't actually fallen off the window. I mean, you're down. The NASDAQ is down what now? 16%. Okay. If you're at your biggest bearish sentiment, you'd be selling a lot more aggressively. You'd see a lot more volume in the overall equity markets. You're not seeing that. I think gold has been on fire, A, because of the inflation trade, B, because people have chased after it. And I think that, it's kind of like that FOMO trade, that, I mean, I'm a fan of gold, but I think that it's going to have a pretty good haircut here in the next, month or two, maybe sooner. I would expect gold to go back and check 2,800, and we're at 3,300 right now. So again, I'm not saying it's going way down. I'm saying that you're getting finally got everybody into the trade. It is crowded. And what happens when trades get too crowded? They go the opposite way. And I think that's going to happen. But overall, am I bearish on the market? Yeah, I think the economy is in bad shape. I think there's a lot of issues. But is Bank of America really that bearish? Or are they trying to force people to sell out so they can let their traders make money? We just saw the earnings on these guys, and they've all made money where? In their trading rooms, not in their fixed income markets.
All right, so you're bearish on the economy and on the markets, but maybe not historically bearish. But you're bearish. We're seeing technical weakness in equities, alongside persistent strength in gold, which could change soon. And I'm with you on that. Despite limited mainstream coverage or clarity on real-time gold market flows, given this environment where narratives are shifting, risk appetite appears to be recalibrating, and gold has remained resilient because people have been calling for gold to fall for the last several weeks, and it's climbing that wall of worry. I'm not saying it's doing that permanently. What does this divergence, though, between equity technicals and gold strength signal to you about underlying market psychology and positioning? In other words, are we entering potentially a new phase of capital rotation towards hard assets?
Maybe. Again, that's a very challenging question, because if you look at the metals themselves, yes, gold has been on fire. And then you say, well, wait a second, the gold silver ratio is at record highs right now. Okay. Right. So why isn't silver participating? And furthermore, why isn't platinum participating in all this movement here? I think this has been a gold only rally. And again, listen, I'm not against it. I own gold, so I'm thrilled that it's gone straight up. I just know from a trading standpoint that at some point, then it might be 3 months from now. I don't know when it's going to be. I can't predict that time, but it will have a pretty dramatic sell-off. But I think the overall shift is just part of the assets that are being bought. I mean, we have not seen an abandonment of buying equities. We haven't seen anything really strange. I think the biggest thing we've watched, and this is not new, this is not since the market selling pressure started. This has been going on for about the last 18 to 36 months, where the volume in the equity market has been drying up. So, again, I've been doing this for 48 years. I've never seen volume drop-offs like we've seen over the last 2 or 3 years. To me, that was a bigger concern in the overall market, because that tells me that there's a lack of participation. There's a lack of people that are actually investing. And we happen to know statistically that only about 8% of the population participants in the bulk of the stock markets anyways. So are we seeing a shift? I can't say that we are. I expect a major sell-off. I expect a lot of people to panic, especially depending on what goes on around the rest of the globe. But right now, is there a major shift? No, I don't think so. And I think the equity market will do what it's done in history, which will be 8.5% year over year as a gain. I still believe the equity markets are the number one place to put money. As long as you're buying good companies that are going to be in business, because again, statistically, in the history of equities, the average return has been 8.5% year over year and 10% year over year since 1950. It's even a better return than gold, as good as gold has been.
Although since 2000, gold has had a better return. Is that correct?
I'd have to look at the exact statistics, but the markets are up since 2000. The Nasdaq's up 300% since 2000. So
yeah,
gold up 300% since 2000.
Well,
I don't know the numbers. I don't have the numbers in my head. So
gold was 250 in 2000, and today it's 3,300. Yeah, so it's up significantly higher than the market.
Right, and the Nasdaq was 1,400 or 900, and it's now 20,000. So,
well, no, actually, it was 4,900 around the 2000.
2001.
And then it collapsed 80%.
Yeah.
But okay.
Either way, 6 and 1/2 does the other. I'm a fan of gold. I'm a fan of equities. I believe that everybody should have some gold.
Absolutely both.
Anyway.
Yeah. No, I'm with you. All right. So, Todd, there's been a lot of talk about a Mar-a-Lago Accords. I'm sure you've heard about this. Given the stark geopolitical and economic differences between 1985 and today, is a modern day Plaza Accord even feasible? And how might current U.S. attempts to pressure China backfire and accelerate de-dollarization trends or lead to other negative consequences?
Well, I think that pressuring China is the right thing to do. I mean, let's face it, China wants to take over the world anyways. I mean, we've all heard of the 100-year plan, okay? With President Biden, they were able to accelerate their plan to maybe a 50-year plan. You know that China has no interest. They want to take over the United States. They want to take over the world. I mean, we've seen evidence of that. Is this the de-dollarization? Are these the things that are going to happen? Again, I don't think these are problems that just started. I think these are age-old problems. And I think that it's fine time that President Trump steps up and stands up to President Xi and tells them, this is the way it is. You don't like it? We're still more powerful. We still have more money. And one of the biggest problems you have is a lot of your money is tied to our debt. And guess what? There's a little panic last week about selling the Chinese selling treasuries. You know what? They can't sell our treasuries. Okay. I mean, at the end of the day, the United States could devalue and tell them to take the money and shove it. Okay. So they're in a position. It's the old story. If you owe a bank 5,000, they own you. If you owe them 5 million, you own them. And we owe China. Obviously, they're our biggest debt holder. And so we hold all the cards when it comes to China. And again, I don't think that we're going to have any massive changes here, because the United States is still the number one place, and we still are the only truly self-sufficient country that could live without any other country in this world.
Do you see anything that could go wrong here? What is the potential negative if China, digs in and maybe takes further steps, and the United States digs in and takes further steps? What's the potential where it can go wrong?
Well, it's higher prices. I mean, it could accelerate a recession potentially. I don't think it can go wrong. I think in that scenario, we win. The United States wins. I mean, again, I would rather have manufacturing in the United States. I would rather pay a little bit more and have better jobs here. I mean, when's the last time you saw other than consultants or customer service jobs? What kind of jobs do we have in this country? And we don't have any customer service jobs anymore because they're all farmed out to India and everywhere else in the world. So I believe that it can't go wrong. I believe I'd rather have the manufacturing here. And you know what? I'm still a believer that COVID was a man-made disease made by China, sent across the world as a form of chemical warfare. And I'm tired of having my prescription drugs come from China. I don't want my manufacturing in China. I want it here. Okay. Again, that's my opinion. That's where I stand on it. So I don't see anything going wrong other than China having to back down, because we are still more powerful than China is.
Not to mention, I agree with you on the pharmaceuticals, and not to mention that the majority of U.S. weaponry components are made over there as well. So, I mean, how do you fight a war against a country that's making the weapons or components for you?
Well, that goes back into the entire chip sector, and even to the cryptocurrency world. But again, that's a story for another day. But at the end of the day, I would rather take control and have it here.
Yeah. All right. So with everything happening globally, from intensifying geopolitical tension, tariff escalations, BRICS coordination, and sanctions to the broader move away from sovereign bonds and towards gold, it feels like we're witnessing a fundamental monetary system shift. This has happened multiple times in history. Maybe you're not feeling that. But let me just lay this out real quick. And if you just don't agree with it or don't see it, it's fine. But President Trump, he's discussed gold more than any modern U.S. president. Judy Shelton, the former Fed nominee, has publicly proposed gold-backed bonds. The Bank of International Sentiments reclassified gold as a Tier 1 asset about 6 years ago. Central banks have been buying gold at the fastest pace in decades. Add to that Trump's rhetoric around a new golden age, and it feels like gold is quietly being repositioned at the center of the monetary system. Now, I'm not suggesting, tying gold back to the dollar or anything. I'm just saying it feels to me like gold is being repositioned globally. Do you believe we're headed towards some new global monetary paradigm with the debt structure and with the way everything is, where gold reclaims some kind of central role? And if so, how do you see this transition playing out?
Well, I don't doubt that. I would love to see that. I think that, of course, you've heard Secretary of Dissent talk about using actually crypto as also as a potential backing for the dollar. Listen, I'm a big believer that the dollar should have to be backed by something. This is one of the problems. This is what made the cartels of the central banking system bigger criminals than they are to begin with. Okay. I mean, the central banks have been stealing from economies since the 1600s in Europe. So I think that having a backing, that changes the dynamics of what true value actually is. And I agree that I would hope that we would get back. I mean, I'm really disappointed, obviously, that we ever got off the gold standard. And the perfect example of the difference in the power of the Federal Reserve versus with the gold standard or without the gold standard, Alan Greenspan, who was the original bubble builder of the federal chairs, right, starting in 1980, when Nixon came out and they wanted to go off the gold standard, Greenspan was vehemently against it. Okay, as soon as he became the Fed chair, he was for it all the way. Tells you something, that when you don't have a backing against a currency, it allows the Federal Reserve and central banks to do whatever they want. So I believe there's a chance that we could get back into some sort of gold standard or some sort of backing of a currency, whether it be through gold, through crypto, through some sort of other type of backing. I think you're 100% correct. I think that is the way it should be. And I do believe that, again, I don't care what you back the dollar with, back it with something that at least we know what true value is, and that we're not continuing to get those Federal Reserve notes, which means we're only getting money that we have to pay back to the government anyways.
And to your point about Greenspan and his flip-flopping, I believe that he wrote some famous paper back in the 60s about gold and why gold was so critical to the monetary system, only to flip-flop here later on.
Well, when it comes to stealing money, you know what happens to these guys. I mean, again, this is the whole problem with the system. Okay, this is the whole problem in our political system. That, again, you ask yourself, why would any politician invest $40 million of their own money to get elected to a $200,000 a year job? Maybe there's more money behind the picture.
Yeah, that's a fair point. All right, so most gold mining funds are up 40 to 50% or more to date just since January 1. Given that oil, a significant cost for gold miners, is down 15% or so year to date, gold prices have, on average, they've surged 20 to 30% year to date. What's your expectations for gold miner earnings and the equities in the next quarter to 2 quarters?
Well, gold miner earnings and gold miner equities, I'm not a fan. So it's hard for me to be objective about gold miners because they've always sharply kind of outperformed an original move, but typically over history have underperformed the market. Okay. And I expect the same thing. I think the earnings will be fine, but I expect the securities to underperform, especially because they're now, if you and I are right, or if I'm right, and we're going into a massive meltdown, then that paper asset is going to get hammered anyways, because it's something that people will run to. But I'm not a big fan of miners in general. I'm more a big fan of owning the physical metals and putting it somewhere where I have control of it and don't have to depend on it. Because one thing I will say is that I don't believe there's enough gold in the world to satisfy the amount of paper that's written on gold. So that's where I believe. So again, I don't trade the miners as a rule. I don't like the miners as a rule. And I don't think they ever perform truly as well as they should. And I think if you look at history, you'll see that the miners are up nowhere near where the price of gold is up over the past 30 years or wherever.
Yeah. So Todd, you mentioned, in our discussion so far that equities are not showing any major stress right now, even though it's down 16% or something year to date. But at the same time, you're expecting a massive meltdown. Are you expecting a massive meltdown in the next 30, 60, 90 days? Are you expecting it to at some point in the next 1 to 2 years? what is your expectation? I mean, no, I'm being serious because
I understand. Listen,
we kind of have this dichotomy going on here where on one hand, it's, I'm expecting a meltdown, but things look fine.
I've been wrong for a year. Okay. And I'm trying to predict the meltdown, right? Again, I have not been short for the year. In fact, basically, I'm always 100% in anyways. I just hedge. I use derivatives to hedge against my portfolio.
Right.
But I've been wrong. So to tell you, I think the highest probability of a meltdown is coming within the next 6 months. Okay. But that doesn't mean that I'm going to be right. And I would not want anybody watching this running out and selling all their assets. Chicken little, the world is coming to an end. I just think that if I look at it from a probability model, I knew, and I said this when President Trump was elected, that you may like his policies, and I do, but there's going to be a lot of pain before he can get what he wants to get done. And I believe that pain is starting. I think we might get a big story as we come in here into the second quarter, into earnings, as they start this week coming ahead with Apple and those guys. In fact, Apple has been one that has been really under a lot of pressure, and along with NVIDIA and Amazon. So there have been some that have been very much beat down. So I would say the highest probability is the rest of this year we could see this major meltdown. Now, remember that when we go back to all the major meltdowns in history, they just didn't happen because of the news. There was a lot of warning signs coming into this. And we've had warning signs for well over a year and a half, telling us that this moment in time is coming. Is it coming tomorrow? Well, no, it's not coming tomorrow. It's Saturday. But is it coming in the next week or 2 weeks? Probably not. But I don't be surprised if you get some big sellouts. But again, remember that the markets have a higher probability of a much bigger sell-off right now. And again, I'll give you 6 months to see that. And once the momentum goes, and once you finally start getting people to panic, you're going to start to see some real heavy selling. And I think that's where we're headed. Again, I can't really time it. And I don't know what the Federal Reserve is going to do, although the Federal Reserve does not benefit the average consumer. They benefit the banks. So
earnings season should be interesting. We've started to see some layoffs from big companies across multiple sectors, from banking, automotive, energy, Mag 7. That might be tied to artificial intelligence developments. Who knows? But we're seeing that. And then on the flip side of the coin, you're seeing demand pulled forward because of the tariffs. So that, that might work against each other in a push-pull. But then the following quarter, we may really see a big difference. But it definitely bears watching.
Well, I think we've had a lot of layoffs. I mean, Meta's laid off a ton. I mean, for the last year, they've been laying off people. I mean, this is the problem when you destroy everything that you build in your own country, and then your people that have nice paying jobs with Meta and Google and others, and all of a sudden they start laying off those people. Where are they going to go? And exactly. I think that's also what President Trump is trying to do, and bring back manufacturing. The unfortunate part of the education system, is that anybody in this country, not any, but most people in this country that are, let's say, 45 and over, if they lose their job and they're not a professional, they're virtually unemployable unless they work at Walmart or whatever. And Walmart's not hiring, so that becomes a problem because guys like me don't have the education to write code, to work on computer programs. We didn't have that stuff, and I never took the time. So I think that's one of the things about manufacturing jobs being in this country. It allows people, 45 and above, to work and make a good living, not try to push shopping carts at Walmart or to groceries or wherever, anywhere, to make $11 an hour versus having a job that they can make $20 or $25 an hour.
Yeah, now it is a different time with robotics and AI. I mean, that might steal quite a bit of jobs that in previous times where we did have the manufacturing sector to fall, on, we had humans who were working in those jobs. Today, many of those jobs can be offloaded to robotics and AI.
100%. You're correct, but you still need some people there that you have to pay. Listen, I'm with you, and I see what's happened in the industry that I grew up in. When I was a floor trader, I started in 1980. We traded in fractions. Okay, we didn't trade in decimals. Okay. So they've destroyed that entire business. And along with that business, they destroyed probably between all the trading floors in the country, probably 5 million jobs.
Wow.
I
So
mean, you know,
just going back to a moment ago, you had said, you expect pain first and then you expect growth second. Are you comparing in your mind's eye, are you comparing the period maybe to Reagan's first term where he had to make some significant changes and adjustments in the early 80s? We got the pain through 83-ish, and then we took off.
I could see that. I think again, there's so many things that have to be revamped and redone. And let's see if our leader today has the courage and balls to take it apart and rebuild it that way and rebuild it with some strength instead of continuing to attach band-aids and sticky tape to try to hold this thing together. As I said, I think there has to be some massive pain felt first before we can rebuild it. And I think we can do it. I think we have the ability to do it. I mean, listen, you have enough jobs, just going back to that for a minute, in rebuilding the bridges and the infrastructure in this country. Okay. You know, every president since I've been alive has always promised one thing: to fix the infrastructure. And how many have done so far? Zero. Okay. So at some point that has to be addressed, and that creates a lot of jobs as well. And I'm hoping that this is the guy, because you want to talk about a way to rebuild an economy, rebuild a country, and rebuild strength, the infrastructure. And again, if you really believe in that green energy crap that they put out there, and I'm not a believer in green energy, but you really want truly green energy, quit stealing from the taxpayers, quit stealing the money to put together stupid programs, and go to nuclear. You want green energy? Go to nuclear. There's nothing better than it.
Yeah. Join our quickly growing community and receive a free report that's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content, but even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com to join us and explore. And thanks again for watching this interview. Now, I'm positive that you've enjoyed the conversation that Todd and I have been having. So please let him know, hit the like and subscribe button, and leave a comment below the video. Todd, we were discussing off camera that we were going to have a lightning round. Let's go ahead and move there. I'm going to ask you to rank a few assets as a buy or a sell. 100 is an extreme buy, 1 is an extreme sell. Then just give 1 or 2 sentences as to why you take the position. We're in the lightning round, so we'll move through it fairly quickly. All right. So for right now, we're going to focus on now, not over the long term, but for now, moving forward over the next couple of months or so. On a scale of 1 to 100, is gold a buy or a sell, and why?
Well, I think gold is always a buy, because again, I think it's going to show you appreciation, just like the equity market. So yes, gold is a buy. At these prices, I'd be a little cautious, but if you're buying it and you're willing to hold on to it, it will be worth more. Even though it's overpriced today, it will be worth more a year from now.
Okay, so what number would you give it? 1 to 100?
Right now, to buy it today,
yes,
I'd give it a 50.
Okay. Gold miners, 1 to 100, and why?
Well, I'm a seller of gold miners. I think they're overvalued, and I would sell them. And at 100, I'd be a seller of gold miners right here.
So then you're a 1, because yeah.
Right.
So
I'm a seller. Well, my opinion is very strong. I want to be a seller. So yes, it would be a 1. I'm a seller of gold miners.
Okay. Silver, physical silver.
I'm a 100 buyer, and I think silver is cheap, and I think that it's unbelievably low priced, especially with the gold silver ratio.
Okay. Silver miners.
Silver miners, I'm a seller, and I'm a 1. I'm a 1 on all miners. Okay. I don't believe in them. I'd rather buy the physical. So I'd buy silver, sell the miner.
Okay. Copper.
Copper is at an interesting area right here. If I'm right on the economy, then I'd have to be a seller of copper, and I'm kind of wishy-washy. So I have to be in the middle at 50.
Okay. Uranium, the metal.
Well, if they would listen to me on energy, I'd be 100 on buying uranium because that would be right tied to nuclear power. But I don't follow a lot of uranium. I would be a buyer, and I would be a buyer somewhere in the range of 20 or 30 times, 20 to 30.
Okay, so that would put you at 70 to 80.
Yeah.
Yeah, okay. Oil.
Oil, I'm a seller. I wouldn't be, again, well, some of the things I think as a trader, and you're lightning around. So some things I look at that are been sold off that should rally a little bit first and then go lower. I think oil is going lower, and I would definitely be a seller at 100. I'd be a very aggressive seller because I do believe it's going into the 40s.
Okay, so you're a 1. Yeah, so one is an extreme sell, 100 is an extreme buy. But
I'm using my opinion, and I'm tying it to a number.
I got you. All right, so oil, you're tying oil though to your prediction on a massive economy and market drop, correct?
Not only that, but I do believe that the reason that we're going to have lower inflation when this is all done is because of the low price of oil. And last time Trump was in office, oil was in the 30s. Yeah. And I believe we can get down there again.
Okay. NASDAQ.
NASDAQ, I would be a seller, and I would be a seller towards, like at a 10 or something like that.
So you're an extreme seller of NASDAQ. Yeah. Do you have a reason?
Well, I think that we're still very weak. We talked during our conversation. I do believe we're headed much lower, and I think it will be led by the NASDAQ as the big rally has been led by the NASDAQ. Okay.
What about the S&P?
S&P, I would be also considered to be a seller. I would probably be a seller at like a level of a 30, not an extreme seller. But again, those numbers can change. If we got a big spike rally, then those numbers would change to a 1. Yeah. I'm waiting for an opportunity to sell at higher prices. But I think that those are hard assets to determine because you would then have to look at the objective of who holds them. Mm-hmm. Okay. And again, some of the questions I can't give you a great answer because I'm holding all of my equities because I'm hedging them.
I understand.
And so I don't want anybody to get the wrong idea that I'm telling you to run out and sell anything. I think the NASDAQ and the S&P every rally should be sold that we see, but be very careful.
Yeah, this is not investment advice. This is just a snapshot picture in time of your opinion right now. Okay. All right. On a scale of 1 to 100, we're going to talk about short-term treasuries. What's your position there?
Sell the futures because interest rates are going higher. 1.
Okay. What about long-term?
Sell the treasuries, right?
Yeah, short-term. 6 months
and
under.
Treasuries.
Long-term?
Long-term, sell the treasuries. Interest rates are going higher.
All right. Now on a scale of 1 to 10, with each representing a percentage, 1%, 2%, 2.5%, where do you see inflation ending 2025?
2025, I expect inflation. Well, first of all, what is the benchmark number you're basing it off of right now?
Yeah, we'll base it off the CPI. What they're calling inflation. So we're what, at 3% right now or so, according to them.
That's BS. It'll be higher.
Okay,
higher. So I'm 100% confident it'll be higher than it is right now.
Okay, 4%.
If you're using 3%, I would say first of all, I believe inflation is at about 12%. So I would say from 12%, it might get to 10. So I'm going to say that we'll get to 7% in inflation that we're going to discuss here.
Okay, so it's going to more than double according to the government statistics before the end of the year.
Yes.
Okay, well that'll cause some major problems if we do experience that.
Well, that's if the idiot feds get involved and start cutting rates. That's what's going to happen. So.
Yeah. All right. Finally, recommended portfolio. It's been 60-40 for the general working person for decades. That's no longer working. Bonds are going down when stocks are going down. There's nothing offsetting. What's your general recommended portfolio with nowadays? Most don't even include gold in the 60-40. So do you have a different general mix that you would put out there today?
Well, I'm a little different in general because I do teach and I do know how to hedge every portfolio to a mathematical certainty. So I would first, if you're interested, I would learn how to hedge. And then you wouldn't have to have any bonds because I own 0 bonds. I never bought bonds ever. I have 1 bar mitzvah bond left from 50 years ago, okay, or 60 years ago. So again, I don't believe in bonds. I don't believe in the fixed income market. I think that right now there are CDs available at 5.5%. That would be someplace I would share money if I were going to take part of it. But I believe that if you know how to take care of your derivatives and hedge them, you can be 100% in the market at all times. I do see a big problem for some. And this comes back to, are you investing money that you need today, or are you investing money for the future? Because if you're taking money that you may need to make a car payment today, then you shouldn't be putting it anywhere. You should be putting it in the bank.
Yeah. All right, Todd, thank you for coming on to Metals and Miners. It's always fun to have our discussions. Would you share a key takeaway that you want viewers to keep in mind, and then let everybody know where they could learn about your work and how they can connect with you?
I think the key takeaway is Gary's got it pretty right and pretty solid. And I think that, again, the markets have a little bit of a problem here, but we have to base all of our decisions on statistical history, because history is not going to change so fast. And of course, the old statement, those who forget history are doomed to repeat it. Don't be the one that's panicking and going crazy here. Use these sell-offs that we're talking about as a buying opportunity. Make sure yourself get you some gold. And if you want to find out or talk to me, you can reach me at bubba@bubbatrading.com is my email, or you can go to bubbatrading.com itself. And I do send out a daily update. So certainly check it out, and I'll be happy to help you with any questions you may have.
I'll have all that information up on the screen. It'll be in the description area, folks. You guys can click through and check out Todd and all of his work. You need to be connected to him. He does a fantastic job. Todd, I look forward to having you back on sometime soon. Thanks for being here. And everybody else, thanks for watching.
Thanks, Gary. Appreciate it.
Join our quickly growing community and receive a free report that's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio.